In 1956, Aramco, an oil company owned by 4 American corporations, paid the government of Saudi Arabia $280 million and paid the United States Treasury nothing at all. Most people, when they hear how America came to dominate the Middle East, are shown a photograph instead of a ledger. The 14th of February, 1945. The USS Quincy at anchor in the Great Bitter Lake on the Suez Canal, a dying American president on the deck, and beside him a king who had come aboard with his own sheep, his own tents, and his own astrologer, oil for security. Both men were really there. The photograph is real. It is pointing at the wrong document. The arrangement that actually built the American position in Arabia was not signed on a deck. It was a tax ruling made quietly in Washington 5 years later, which no voter approved and almost no American has heard of. It worked by changing one word in a company's accounts. A payment that had been called a royalty was renamed an income tax, and once it carried a different name, the bill for it moved from the company to the American public, which is why those two numbers from 1,956 are not two separate facts. $280 million to Riyadh and nothing at all to the Treasury were the same fact seen from either end. Oil mattered, and the strategic case for the relationship was real. What the photograph cannot show you is the accounting decision underneath it, and once you can see the ledger, a great deal of what followed stops being mysterious. So let's go back, not to 1945, but to the spring of 1933. First, what an oil concession actually was, because the word makes it sound like a contract between equals, and it was nothing of the sort. A concession gave a foreign company the exclusive right to look for oil, produce it, refine it, and sell it across an enormous area for a period measured in generations. In return, the host government received a signature payment, an annual rent, and a royalty on each ton produced. Now look at where the leverage sits. The company decides how much to produce. The company decides where the oil goes and at what price it is booked. The company keeps the accounts. And the government that owns the ground has no right to audit any of it, no technical staff who could check it, and no real idea what the oil is fetching in Rotterdam or New Jersey. You are not being paid a share of what your asset earns. You are being paid a number that somebody else calculates and hands you. That is the system a bankrupt desert kingdom walked into in 1933. Abdulaziz ibn Saud had conquered most of the Arabian Peninsula and had almost no money. His main revenue was the pilgrimage to Mecca, and the pilgrimage had collapsed along with the world economy after 1929. He needed cash immediately, and he had one thing to sell that cost him nothing: permission. 2 bidders came: the Iraq Petroleum Company, which was British-led, and Standard Oil of California, which was not. The American negotiator was a mining engineer named Carl Twitchell, who had already surveyed the kingdom for water and minerals and was trusted at court. The British thought they were bidding for a dry hole. The Iraq Petroleum Company already had more oil than it could sell out of Iraq and Persia, and its interest in Arabia was mostly defensive to stop anyone else getting in. So it offered to pay in rupees rather than gold, and it moved slowly. The Americans wanted it, paid in metal, and moved fast. The concession was signed on the 29th of May, 1933. It covered roughly 930,000 square kilometers of eastern Arabia, an area larger than France and Germany combined. The initial payments and loans came to something in the order of $175,000, much of it in gold sovereigns, because the king did not want paper. The largest concentration of cheap oil ever found on Earth, and the price of the option on it was a sum a mid-sized American town could have raised. The company that signed it was a subsidiary of Standard Oil of California. Texaco bought half of it 3 years later. Standard Oil of New Jersey and Socony Vacuum came in after the war, and in 1944 the whole thing took the name it has carried ever since. The Arabian American Oil Company, Aramco. Nobody knew that yet, and that is the honest part of this. For 5 years, the geologists drilled and found nothing worth having, and the company came close to walking away. Then on the 3rd of March, 1938, a well called Dammam No. 7 came in and kept coming, and within a short time was producing thousands of barrels a day. And here is where the story gets strange. Within 4 years of that discovery, the United States was at war, and Saudi Arabia, a neutral kingdom with no army worth the name and no alliance with anybody, had been declared a matter of American national security. In February 1943, President Roosevelt signed a determination extending Lend-Lease aid to Saudi Arabia on the stated ground that the defense of Saudi Arabia was vital to the defense of the United States. Lend-Lease existed to keep allies fighting Germany and Japan. Saudi Arabia was fighting nobody. It qualified because of what was under its sand. The aid was not only money, and it is worth getting the sequence right because it was slower than it is usually told. The Lend-Lease determination came in 1943. The War Department pressed for an American airfield in the Eastern Province in 1944. The agreement covering it was signed in 1945, and the field at Dhahran was finished in 1946 with American personnel to run it. So it took most of a decade rather than an afternoon. But a country that in 1938 had been a commercial prospect was, by the end of the war, hosting American infrastructure paid for by American appropriations, and a supply relationship had begun that has never really stopped. That is the moment a commercial concession became a state interest, and everything afterwards follows from it. The meeting on the Quincy 2 years later is remembered because it makes a good photograph. What it settled was less than people assume, and it left open the only question that mattered: how the money would be divided. There is a version of what happened next in which a king finally drove a hard bargain with an oil company, and the Saudi share went up because Riyadh pushed. That version has the wrong room. The decisive move was not made in Arabia at all. It was made in Washington, and the company was not the one that paid for it. The pressure was real enough. In 1948, Venezuela had forced a 50-50 split of profits on the companies operating there, and the Venezuelan oil minister, Juan Pablo Pérez Alfonso, made sure every other producing government heard about it. Riyadh wanted the same. The oil companies did not want to pay it. In 1950, the United States government found them a way not to. Here is the mechanism, and it is worth going slowly, because the whole story turns on it. American tax law treated money paid to a foreign government in two very different ways. A royalty was a business expense. You subtracted it from revenue, worked out your profit, and paid American tax on what was left. Useful, but limited. A foreign income tax was something else. Under the foreign tax credit, money paid as income tax to a foreign government came off your American tax bill directly, dollar for dollar, so the same profit would not be taxed twice. So in late 1950, Saudi Arabia introduced an income tax on the oil company, calibrated so that what the company paid Riyadh came to half the profits. The company did not resist, because it was giving up very little. Every extra dollar it now paid the king came off what it owed the United States Treasury. The money that doubled the Saudi share did not come from the company. It came from American public revenue, routed there by a ruling rather than a vote. The scale was reported at the time. By 1956, the company was paying Saudi Arabia around $280 million a year, and in that same year, by deducting those payments and using the depletion allowance available to all American oil producers, it wiped out its United States corporate tax liability altogether. And notice what the 50-50 split did not include. It did not give Saudi Arabia the right to inspect the company's books, or to see the contracts under which the oil was sold onward, or to put its own auditors into the accounting department. The kingdom received a statement and a check. For years, the state that owned the oil had no independent way of testing whether the half it was being handed was half of anything real. Its nickname among the people who knew about it was the golden gimmick. This was not illegal, and the officials who wanted it were not fools. They had a specific fear, and you can see exactly what it was by looking at the country next door. In Iran, the British-owned Anglo-Iranian Oil Company had refused a comparable deal. Its accounts were famously opaque. Its Iranian workers were famously badly housed, and in some years it paid more in tax to the British government than it paid in royalties to Iran. In 1951, the Iranian parliament nationalized it, and Mohammad Mossadegh became prime minister on the strength of that decision. Britain organized a boycott, Iranian oil stopped moving, and in 1953 Mossadegh was removed in a coup organized with British and American involvement. Washington in 1950 was watching that argument build. The golden gimmick was the answer to it. Give the king enough that he does not need to take it, and leave the company's own profits untouched so it does not fight the arrangement. It worked. Saudi Arabia did not nationalize in the 1950s. Iran did, and paid for it. But a foreign policy of that consequence went through the tax code, which meant it never reached Congress, never appeared in an appropriations debate, and was never explained to the people funding it. The mechanism was not chosen because it was cheapest. It was chosen because it was quietest. Which brings us to the group who paid for it and appear in almost no account of it. An American on an ordinary wage in 1956 was paying income tax. Part of what that tax covered was revenue the federal government did not collect because a company operating in Arabia had been allowed to treat a payment to a foreign monarch as though it were a tax. There was no line on anybody's return that said so. No debate, no vote, no campaign. The transfer was real, it was large, and it was invisible by design. That is what doing foreign policy through the tax code buys you. It does not feel like spending. Nobody experiences it as a payment, and a cost nobody experiences is a cost nobody argues about, which is a large part of why officials reach for the instrument in the first place. It did eventually come out, though it took a generation. In the middle of the 1970s, a Senate subcommittee on multinational corporations went through the oil company's own files in public hearings, and a good deal of what had been internal correspondence between Aramco, its parent firms, and the State Department went into the record. Congress later narrowed the tax treatment that had made the whole thing work. By then, it had been running for a quarter of a century, and the position it bought was permanent. That is the pattern worth carrying through the rest of this. The arrangement is not usually reversed when it is discovered. It is discovered long after it has finished doing its work, and by then the thing it built has its own reasons to exist. And I want to stay on the ground for a moment, because the oil did not lift itself out of the sand. Tens of thousands of men pulled it out. Saudis from the villages of Al-Hassa, and workers brought in from Italy, India, and Pakistan. The camps they lived in were not one place. They were three. Senior American staff lived in an air-conditioned town with lawns, a cinema, a swimming pool, and a commissary, laid out like a suburb transplanted from California. Middle-ranking staff lived in a second, plainer settlement. Saudi and other Asian laborers lived in a third, which for years meant barracks, and in the early days for many of them tents and reed huts, with sanitation the company's own inspectors described as inadequate. The historian Robert Vitalis went into the company's archives for his book America's Kingdom and argued that the story the firm told about itself, a benevolent partnership bringing development to the desert, concealed a racially ordered labor system imported more or less directly from American oil camps and from Jim Crow. He has critics who think he presses the comparison too hard and underrates how much changed over time. The documentation on the early camps is not really in dispute. There is a detail from those years that stays with me. The training program was genuinely good, and Saudi men who came through it became competent engineers. But the ceiling was fixed, regardless of competence. You could be the best man on the job and still be paid on a different scale, housed in a different camp, and promoted only to a level that had been decided before you arrived. The pay scales were not a secret either. They were written down, and they were organized by nationality rather than by job. An American, an Italian, an Indian, and a Saudi doing comparable work sat on different lines of the same table, and the company defended this at the time as a reflection of what each man could be recruited for on his home labor market, which was true, and which is also the standard defense of every arrangement of that kind ever operated. In 1953, the Saudi workers struck. They wanted better pay, better housing, the right to organize, and promotion into jobs reserved for Americans. The strike was broken. Leaders were arrested and sent back to their villages. Strikes were subsequently outlawed. Some of it improved afterwards. Over the following decades, Saudis moved into the skilled and then the senior positions until the company became and remains one of the most capable engineering organizations on earth. And that change was substantially the achievement of the Saudi workforce itself. But hold the two facts together for a second. The revenue coming out of those camps was being divided 50-50 between a company and a king, and the division had just been doubled by a ruling in Washington. Nobody in the third camp was told that. Nobody asked them what a fair split would look like. And here is where the hidden man comes in. Abdullah Tariki was born in 1,919 inches, a small town in the Najd, the son of a camel caravan trader, and he did something almost nobody of his background did. He went abroad and learned the technical side, taking a master's degree in petroleum geology and engineering at the University of Texas in 1947, then working for an American oil company before coming home in 1948. That mattered more than any diplomat, because Tariki could read the accounts. Here's what he had spotted, and it is the most valuable idea in this story. The oil was not sold on an open market. It was sold by the producing company, mostly to refining and marketing companies owned by the same parent firms. So the price used to calculate everyone's share was not a market price discovered between a willing buyer and a willing seller. It was an internal number, the posted price, set by a group that stood on both sides of the transaction. Apply the 50-50 formula to that. If the company decides the price at which the oil leaves Arabia, it is deciding the size of the profit that gets split, which means it is deciding the king's income. Half of a number you control is not a partnership. It is an allowance. And the companies proved his point for him twice in public. In February 1959 and again in August 1960, they cut the posted price unilaterally. No negotiation, no notice worth the name. A number that determined the entire income of several states was lowered by the firms that set it because there was too much oil on the market and their margins were tightening. Every producing government lost revenue overnight, and none of them had been asked. That is what a price you do not control actually feels like when it moves against you, and it did more to convince Riyadh, Caracas, Tehran, Baghdad, and Kuwait that Tariqi was right than any speech he ever made. In September 1960, he went to Baghdad with Perez Alfonso of Venezuela, and together they founded the Organization of the Petroleum Exporting Countries. In December of the same year, he became Saudi Arabia's first Minister of Petroleum. He lasted 15 months, and it is worth being honest about why, because the tidy version of this, in which a lone truth-teller is destroyed by the system, is not quite what happened. Tariqi was right about the accounting and impatient about everything else. He wanted rapid Saudi control of an industry his country could not yet run without American engineers, and he said so in public, in a monarchy where policy was not usually argued in the newspapers. He also attached himself to a reformist movement inside the royal family and was involved in announcing a draft constitution, which handed his opponents a political weapon that had nothing to do with oil. In March 1962, he was dismissed. The political scientist Jeff Colgan has argued that the underlying problem was his nationalist position, though it was other events that triggered the removal. He was replaced by a young, urbane, American-trained lawyer named Ahmed Zaki Yamani, who then spent 24 years getting most of what Tariqi had wanted, slowly, by negotiation, and without ever losing the room. Tariqi went to Beirut and set up as a consultant, then moved to Cairo, and died there in 1997. He is remembered, when he is remembered, as a founder of OPEC, rather than as the first person inside the Saudi state who could read what the company was doing. Yamani's method was the opposite of his predecessors. Where Tariqi had demanded control, Yamani negotiated for a share and then enlarged it, year by year, in agreements the companies could live with, until one day the share was everything. He was widely regarded in the industry as the most skillful negotiator any producing state ever had, and he got there without a single confrontation his government could not afford. It is an uncomfortable comparison. The man who was right first achieved nothing, and the man who moved slowly achieved all of it. Then came the 13 months that changed the structure. In October 1973, the Arab producers cut output and embargoed shipments to the United States and others. The posted price of oil, which had barely moved for 2 decades, roughly quadrupled between the autumn of 1973 and early 1974. Saudi revenue, which had been in the region of $1 billion a year at the end of the 1960s, ran into the tens of billions within a few years. A state that a generation earlier had needed $175,000 badly enough to sell an area the size of France was now taking in more each week than the entire first decade of the concession had produced. It is worth pausing on how fast that happened. In the autumn of 1973, a barrel of Arabian Light was posted at under $3. By January 1974, the figure was above $11. Nothing in the physical world had changed. The same wells, the same pipelines, the same tankers. What had changed was who set the number, and for the first time in 40 years, it was not the companies. Everyone remembers the queues at the petrol stations. Fewer people ask the obvious follow-up, which is where all that money went. A price shock of that size does not only take money from consumers, it deposits it somewhere. Suddenly, a small number of governments were receiving dollar revenues too large to spend at home, and the international financial system faced a real risk. Those surpluses could sit idle or move somewhere the United States could not see. There was a second worry underneath the first. If the surpluses went into gold, or into other currencies, or into buying real assets across the Western economies at a pace nobody could absorb, the consequences were unpredictable. What Washington wanted was for the money to come back as debt, held quietly, in an instrument that could not vote and could not be sold in a hurry without the seller taking the loss. So in 1974, the American Treasury sent officials to Riyadh and an arrangement was reached. Saudi Arabia would place a large part of its surplus in United States government debt. The purchases would be made outside the normal public auctions as what were called add-ons, and the Saudi holdings would not be identified separately in the Treasury's published country tables. They were folded into a line covering oil exporters as a group. That confidentiality held for more than 4 decades. The figures became public in 2016, after Bloomberg News obtained them from the Treasury under a Freedom of Information request. It is worth keeping the two arrangements apart in your head because they are often blurred into one. The 1950 ruling was American tax law, and it changed who paid the king. The 1974 understanding was American debt management, and it changed where the king's money went afterwards and who was permitted to see it. 24 years apart, different departments, different instruments. What they had in common was the method. Both were technical, both were settled by officials rather than legislators, and both were built so that the arithmetic would not be visible to the people on whose behalf it was done. Now, I have to separate this from a much wilder story, because this is exactly where credibility gets lost. There is a popular claim that Saudi Arabia agreed in 1974 to sell its oil only in dollars and that this is what made the dollar the world's reserve currency. That version does not survive contact with the evidence. There was no exclusivity clause of that kind. Saudi Arabia went on accepting other currencies, including sterling, and the dollar's reserve role was already established for reasons that had nothing to do with Riyadh. What actually happened is less cinematic and more interesting. The surpluses were recycled, quietly and at scale, into the debt of the country that had bought the oil. The economist David Spiro examined the arrangements at length and argued they gave the United States a structural advantage that open competition would not have produced. Others think he overstates how much the secrecy mattered. That argument is still live. And then, in the middle of all this, the Americans lost the company. Not seized in a night with soldiers at the gate, the way Iran had tried in 1951, but bought in stages over most of a decade. Saudi Arabia took a quarter of Aramco in 1973, a controlling share the following year, and completed the purchase by 1980. The Americans who had run it stayed on under contract. The technical relationship never broke for a single day. By the logic of the 1930s, this should have ended the American position in Arabia. The asset was gone. The concession was gone. It made no difference. If anything, the relationship deepened, because by then the connective tissue was not the wells. It was the recycled surpluses, the arms contracts, the training programs, the engineers, and a shared interest in keeping the price of a commodity inside a range that suited both. The position had been built on ownership. It survived the loss of ownership, because it had already been converted into something harder to nationalize. Now, let me bring all of these threads together, because none of these decisions on its own builds a relationship that lasts 90 years. A bankrupt kingdom in 1933 sold an option on the largest concentration of cheap oil on Earth for a sum a mid-sized town could have raised, and a discovery 5 years later turned that commercial gamble into a matter of American national security before anyone had negotiated the terms of it. A tax ruling in 1950 then doubled the king's income at almost no cost to the company, because the difference was charged to the American public through a change of wording, and the man who worked out what that arithmetic really meant was out of office by 1962. And when the price finally moved in 1973 and the surpluses arrived, an arrangement the following year steered them into American government debt and kept the figures out of the published record for 40 years, so that a complete nationalization by 1980 changed the ownership of the oil and almost nothing else. Take any one of those alone and you have a commercial deal or a diplomatic episode. Put them in sequence, and you have an architecture that has outlived the Soviet Union, the concession system, and the American need for Saudi oil. The concession is gone. The golden gimmick was closed off by Congress. Aramco belongs to the country it sits in. What has not gone anywhere is the method. The most consequential decisions in international economics are still made through instruments designed to be boring. Nobody campaigns about the classification of a payment. And yet reclassifying one payment in 1950 did more to fix the American position in Arabia than most of the agreements signed that decade, with far more ceremony. It is worth being precise about why that is, because tax law in general is not the point. Congress writes the tax code, and it argues about it in public. What happened in 1950 was one level below that. It was a ruling about which existing category a particular payment by a particular company in a particular country belonged in, and a decision of that kind never reaches a vote. It is also a decision not to collect, rather than a decision to spend, and those two things look completely different on paper while being identical in the bank. That gap between the law and the interpretation of it is where a great deal of quiet policy has always lived. The other pattern is what happens when a relationship outlives its purpose. The United States is now the largest oil producer in the world, and does not need Saudi crude the way it did in 1950. The commodity logic has largely gone. The financial architecture built on top of it, the surpluses, the holdings, the contracts, the sovereign funds, is still there and still growing. The next time someone tells you that America built its position in the Middle East with aircraft carriers and covert action, you will know better. The carriers are real, the interventions were real, some of them were catastrophic, and nothing here argues that force played no part. But the foundation was laid before any of it, by lawyers and accountants, in documents written to be unreadable. A tax ruling does not photograph well. There is no famous image of it, and no anniversary. Abdullah Tariki spent his last years in Cairo, consulting, writing, largely forgotten, having been right about the arithmetic and early about everything else. He lived long enough to see the posted price abolished, the concession system dismantled across the whole producing world, and his own country own its oil outright. None of it was credited to him at the time, and he was not invited back. In December 2019, Saudi Aramco sold a small slice of itself on the exchange in Riyadh and was briefly valued at close to $1.7 trillion, the most valuable listed company in the world. Not one share of it was held by the American firms that founded it. The country got the asset in the end, and it is worth being fair about how. Tariqi saw where it had to end up before anyone else in his government did. Yamani found the political road that actually got there. Neither of them could have done the other's half, and the arithmetic had to be understood before it could be negotiated. And the tax ruling that started all of this has no plaque, no museum, and no date anybody marks. It exists as a few pages of correspondence between a company, a State Department, and a Treasury, written in the flattest language its authors could manage, which was the entire point. If this is the kind of history you want more of, subscribe. And tell me which one you would put first. The concession bought with gold sovereigns in 1933, the tax ruling of 1,950 that sent the bill to American taxpayers, or the recycled surpluses of 1,974 that nobody was allowed to see. I read every single one,